Welcome to this quarter's Observations in Global Equities and Fixed Income. I'm Adam Sparkman, Client Portfolio Manager with Thornburg Investment Management. Again, I'm joined by Ben Kirby and Jeff Klingelhofer, the firm's co-heads of investments. Gentlemen, last video we discussed market sentiment and outlook after what was a very strong first quarter. Today I want to follow up the conversation discussing a little bit of topics on market concentration, if we get more breadth from here, and then also kind of the Fed's rate forecast for the rest of 2024. So Ben, maybe sticking with equities to start, I think really the surge that we saw across the S&P 500 during 2023 was primarily driven by the Magnificent Seven and maybe a small handful of other kind of large cap growth stocks. Many of those stocks continued to perform really well into the first quarter of the year, the strong rally that we had. But we also saw some non-tech sectors. We saw financials, utilities, and industrials all put up double-digit returns during the first quarter. With that in mind, do you think that that's a sign of, really a turn in the concentration that we saw last year and the opportunity for this rally to really broaden out from here?
Yeah, you're right. So 2023 really was a pretty narrow market, as you alluded to. But actually, since the market bottom in October 30th of 2023, both the equal weighted and the market cap weighted S&P are up about 25%. So you've actually had a period where the average stock is kept up with the big mega caps over that time period. That being said, look, there are a lot of other really interesting investments out there besides just the Mag 7. So those companies they have great balance sheets, they have cash flow, they have growth, they have a lot of things going for them. There's other investments as well in the equity market that are really attractive and interesting. It is great to see the market broaden out. It really does help active managers have more places to invest, more places to add value. We think that probably continues, mostly because the valuation discrepancy between those high growth companies and the rest of the market has gotten so wide that there's a lot of room for the other companies to catch up.
Jeff, turning to the fixed income side, last month, I think basically as expected, the Fed kept their target rate unchanged. But when we look out through the rest of 2024, the Fed is still forecasting 3 rate cuts over the course of the year. That's despite what I think were pretty good economic data during the first quarter. We talked about in the last video, I think stickier inflation than maybe some were expecting. So given kind of that current environment that we're in, do you think that the Fed's current forecast is realistic?
I think you've got to take it one level farther, right? I mean, we've talked a lot of times about that Fed's third mandate. And just to remind our viewers, the Fed does indeed have 3 mandates, right? So there's maximum employment and there's price stability, the 2 we always talk about. And so from that lens, really, the Fed has done a wonderful job, right? Unemployment has stayed very, very low. The consumer's been supported. They've also managed to go from an inflationary environment of near 10% down to just under 3%, pretty close to their 2% target. Now, when we enter in that third mandate, which technically is moderate long-term interest rates, but I've argued for quite some time is one of social stability, compressing the wage gap, we're seeing this play out. But what this is doing, those high-income service workers are indeed creating a very sticky form of inflation. And what the Fed has tried to do is pivot to saying, well, we've got inflation under control, so it makes sense. We should lower rates and hope to continue the soft landing that we've talked about here from some time. But I think the challenge to that is, as you look forward, all of the sticky inflation is, again, we're starting to see inflation, if anything, maybe inflect back up. So my view, and I've said this a number of times, it would be a policy mistake at this point for the Fed to cut, right? It would be setting us up for the potential repeat of that late 70s, early 80s, where we did see inflation spike, come down, Fed cut proactively, and all of a sudden we saw that spike up. So my base case is I don't think we're going to see the Fed cut 3 times this year. I think we might get 1 token cut, but really I don't think they should be cutting at all, given the strength of the underlying economy, the strength of the consumer, and even in the face of higher rates, what are continuing to be relatively easy financial conditions for your average corporate, government, or consumer.